Hello, I'm Sebastian. Welcome to Nine Trees podcast. Today, I will summarize and review the book. Mastering the Market Cycle. Getting the Odds on Your Side by Howard Marks is a practical guide to understanding why markets and economies move in recurring patterns and how investors can respond more intelligently. Marks, well known for his work at Oaktree Capital and his widely read investment memos, focuses less on predicting exact turning points and more on recognizing where we are in a cycle and adjusting behavior accordingly. The book frames cycles as a natural result of human psychology, credit availability, risk appetite, and institutional incentives. Rather than promising a formula, it teaches a way of thinking. Observe key indicators, compare current conditions to historical norms, and act with discipline when emotion dominates the crowd. Readers are encouraged to appreciate that cycles are inevitable but also variable in length and intensity, making humility and probabilistic judgment essential. The core message is that better timing is about tilting the odds, not calling tops and bottoms with certainty. I will give you key takeaways from this book. Firstly, why cycles exist and why they never disappear. Marx presents cycles as a feature of capitalism, not a bug. Economic activity, corporate profits, investor sentiment, and credit conditions tend to overshoot in both directions because people, institutions, and incentives rarely remain perfectly balanced. When times are good, confidence grows, lenders loosen standards, and investors accept lower returns for perceived safety. Those behaviors reinforce one another, creating self-sustaining expansions. Eventually, optimism becomes complacency, risk is underpriced, and leverage builds. Then, a trigger, sometimes small, reveals fragility and the process reverses. Fear rises, credit tightens, investors demand higher returns, and assets can become cheap relative to fundamentals. A key takeaway is that the same forces that push markets too far up also push them too far down. The book stresses that cycles do not repeat with mechanical regularity. They rhyme rather than replicate, which is why simplistic checklists can fail. Marx emphasizes the importance of understanding the drivers behind a cycle phase, psychology, liquidity, and the interaction between fundamentals and valuation. He also highlights that cycles can occur at different levels simultaneously, such as business cycles, credit cycles, and cycles in specific sectors. Recognizing that multiple cycles overlap helps explain why a market can look strong while pockets of excess form beneath the surface. The investor advantage comes from accepting cyclicality as inevitable and preparing to respond rationally. Secondly, the credit cycle as the engine of booms and busts. A central theme is that credit availability often matters as much as earnings or growth. When lenders compete to extend capital, terms become easier, lower spreads, lighter covenants, higher loan-to-value ratios, and greater tolerance for weak cash flows. That abundant credit can inflate asset prices directly and indirectly by enabling leverage, buybacks, acquisitions, and speculative projects. Marx argues that the credit cycle can turn even if the economy appears fine, because the key variable is willingness to lend rather than absolute default rates. The book encourages readers to watch practical signals of credit looseness or tightness. These include the ease with which lower-quality borrowers raise money, the popularity of covenant-light structures, the pricing of high yield relative to safer bonds, and the general attitude toward risk in lending committees and markets. When capital is plentiful, investors may forget that credit losses arrive in clusters. Conversely, after losses, lenders can become overly restrictive, cutting off credit to otherwise viable borrowers and deepening downturns. Marx also links the credit cycle to opportunity. Distress, forced selling, and refinancing pressure can create attractive entry points for patient investors who maintain liquidity. The lesson is not to avoid credit entirely, but to respect how quickly it can amplify outcomes. By tracking credit conditions, an investor can better gauge whether returns are being earned through real value creation or through the temporary tailwind of leverage and easy money. Thirdly, risk, sentiment, and the pendulum of investor behavior. Marx is known for describing markets as swinging like a pendulum between extremes of fear and greed. In this framing, the biggest errors come from emotional extrapolation, assuming recent trends will persist, and paying too much for perceived certainty. When sentiment is euphoric, investors treat risk as if it has disappeared. They accept optimistic forecasts, ignore downside scenarios, and price assets for perfection. In the opposite extreme, fear dominates, and investors assume the worst, demanding punitive discounts and avoiding even high-quality assets. The book emphasizes that risk is not a static label tied to an asset class. Risk is largely a function of price paid, investor expectations, and fragility created by leverage and crowded positioning. Something can be safe when it is priced for disappointment and dangerous when it is priced for flawless execution. Marx urges readers to separate fundamental outlook from valuation. A good company can be a bad investment if it is too expensive, while a troubled asset can be attractive if the price already reflects grim assumptions. To use sentiment constructively, the investor must observe the environment. Are investors chasing returns, dismissing caution, and funding speculative stories? Or are they demanding proof, liquidity, and margin of safety? Marx does not claim perfect contrarian timing, but he argues that moving from aggressive to defensive and back again as attitude shift can improve long-run outcomes. The practical goal is to resist the crowd at extremes while remaining grounded in probabilities. Fourthly, positioning the portfolio across a cycle. Without predicting dates, rather than forecasting exact peaks and troughs, Marx focuses on calibration. He advocates adjusting portfolio posture based on the balance between prospective return and prevailing risk. When assets are richly priced, credit is loose, and optimism is widespread, forward returns tend to be lower and downside larger. In that setting, a prudent investor might emphasize quality, liquidity, and selectivity, hold more cash than usual, or avoid highly levered and cyclical exposures. The point is not to abandon markets, but to reduce vulnerability. When conditions reverse, assets may be discounted, spreads widen, and pessimism dominates. That is often when the odds improve for taking risk, even though it feels most uncomfortable. Marx highlights the importance of having dry powder, psychological preparedness, and a decision framework established before panic arrives. Waiting for perfect clarity usually means missing the best prices. The book also underscores that cycle-aware positioning is about degree. Investors can shift along a spectrum from more aggressive to more defensive, rather than flipping all in or all out. This nuance helps avoid the common pitfall of trying to time everything perfectly. Marx encourages continual assessment of where current conditions sit relative to historical norms, valuations, credit terms, default expectations, and investor behavior. By making incremental adjustments, investors aim to capture most of the upside while reducing the probability of catastrophic loss. Over time, avoiding deep drawdowns can be as valuable as finding spectacular winners. Lastly, second-level thinking and the discipline to act. When it feels wrong, Marx builds on his broader investing philosophy by stressing second-level thinking, going beyond obvious conclusions to consider what is already priced in and what could surprise the market. In cyclical contexts, first-level thinking often says things look great after long rallies and terrible after steep declines. Second-level thinking asks whether expectations have become too high or too low, and whether the next move is more likely to disappoint consensus. The book highlights the behavioral challenge of cycle-aware investing. Doing the right thing frequently feels wrong. Being cautious near market highs can look foolish while prices keep rising, and buying amid distress can feel reckless when headlines are bleak. Marx argues that the ability to endure social and emotional pressure is a real source of edge. He also emphasizes humility, cycles are uncertain, and even correct views can be early. That is why he favors a probabilistic mindset and margin of safety rather than heroic precision. Practical discipline comes from process. Investors can define signals that indicate exuberance or despair, set rules for position sizing, and insist on underwriting downside cases. They can also focus on avoiding permanent capital loss, not just volatility. By combining second-level thinking with awareness of cyclical extremes, the investor aims to make fewer big mistakes. In Marx's view, long-term success is often the result of consistently being a little more right at the turning points and a lot less wrong when others are overconfident. In conclusion, this book is best suited for investors, finance professionals, and serious individual savers who want a clearer framework for understanding market environments rather than a stock-picking recipe. It is also valuable for readers who have lived through bull and bear markets but still find it hard to explain why risk seems invisible at the top and overwhelming at the bottom. Marx can benefit a reader's life by improving decision quality under uncertainty. By learning to identify signs of excess and distress, readers can better manage leverage, liquidity, and expectations, which can reduce the chance of destructive losses and help them stay invested with discipline. The approach is especially useful for long-term wealth building because avoiding major drawdowns often matters more than chasing the last bit of upside. Compared with similar investing books that focus on forecasting or rigid rules, this one stands out for its realism. It does not pretend that anyone can time markets perfectly. Instead, it offers a pragmatic way to tilt odds through observation, valuation awareness, and behavioral control. The emphasis on credit conditions and sentiment provides actionable context that many generalized market guides overlook. If you want a mindset that travels well across cycles, this book is worth buying and revisiting. If you would like to support Howard Marks, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.